Trading trends is frustrating when your indicators can't reveal hidden trends. You wait for confirmation, finally enter, and then price immediately pulls back, stopping you out right before the real move. But what if you could see trend structure the way institutions do, using logarithmic regression that captures exponential price patterns? That's exactly what this indicator does. And in this video, I'm going to show you how logarithmic regression reveals hidden trends, the perfect settings for your market, and a complete three-phase strategy for trading these signals. Let's get into it. First, head over to TradingView and pull up any chart you want. I'm using the 1 hour time frame on BTCUSD, but this works on any market, any time frame. Next, click on indicators and type in logarithmic regression channel trend. Make sure you select the one by Big Beluga. Now, unlike most trend tools that use linear math with the assumption that price moves in straight lines, which is why they lag so badly, this one uses logarithmic regression to model exponential growth and decay patterns, capturing how markets actually move. Let me show you what makes it really effective. You've got this regression channel flowing through price, green during uptrends and red during downtrends. But this is not just an ordinary moving average. This is a mathematically fitted curve based on log regression that adapts to exponential price movements. When you take a closer look inside the channel, you'll see upper and lower bands. When price touches the upper band during an uptrend, it shows overbought within that trend, a potential pullback zone. And when it touches the lower band during a downtrend, it shows oversold within that trend, a signal that a possible bounce is incoming. This ribbon itself changes color based on crossover logic. When the regression line crosses above its 3-bar back value, the ribbon turns green, signaling bullish momentum is building, and when it crosses below, the ribbon turns red, a sign that bearish pressure is taking over. In the corner, you've got a dashboard showing 3 critical metrics: the regression slope multiplied by 100, the channel direction, and the current trend status. This gives you a quantified read on trend strength, not just a color change, but actual numbers showing how steep the trend is. Most traders struggle because they rely on random signals without a clear system. That's why we focus on structured strategies and automation, so you can study how these tools work step by step without guesswork or emotions. If you want to learn more and see exactly how these strategies are applied in real market conditions, click the first link in the description. Now, before I show you the strategy to trade it, let's get your settings right. Double-click on the indicator to access the settings panel. You'll see the look-back period setting, which controls how much historical data the regression uses to calculate the curve. It's set to 100 by default, and I've found that works well for most time frames as it gives you a smooth curve without being too laggy. If you're on lower time frames like 5-minute, drop it to 80 for more responsiveness. But if you're on higher time frames like daily, bump it to 150 for a steadier long-term read. Next, you've got the channel width multiplier, which controls how wide those upper and lower bands sit. Higher values create wider bands, fewer touches but stronger signals when price reaches them. Lower values create tighter bands, more touches but potentially more noise. I recommend keeping it at default and adjusting based on the volatility of your specific market. Under the Style tab, enable the dashboard so you can see the regression slope, channel direction, and trend status metrics. Also, make sure the midline is visible as this often acts as dynamic support and resistance within the channel. After that, click OK. Now let me show you exactly how to trade this with a 3-phase confirmation system. Phase 1 is channel direction. This is your big picture bias. When the regression channel is green, it means you're in a bullish environment. Only look for long setups. But when it's red, it means you're in a bearish environment. Only look for short setups. Next, you want her to check the dashboard. If the regression slope value is positive and direction shows down, it means you're confirmed bearish. But if the slope is negative and the channel direction shows up, it means you're confirmed bullish. Phase 2 is the ribbon crossover signal. Once you've confirmed the channel direction, wait for the ribbon color to align. In a green channel, you want to see the ribbon turn from red to green. That crossover is your momentum shift signal, happening before price fully reverses. In a red channel, you want the ribbon to turn from green to red, marking bearish momentum taking control. When you see the ribbon color match the channel color, you're now at phase 2, confirmation. Phase 3, the band position entry, is the final piece. This is where you need the optimal entry timing. For bullish setup with green channel and green ribbon, wait for a pullback to the lower band or the midline. Price touching these levels within an uptrend is your final confirmation, as the market is giving you a retest entry at a mathematically favorable price. Enter long when price wicks into the band and shows bullish rejection, a candle with a long lower wick and strong close near the highs. Place your stop loss just below the lower band and target the upper band, or use 2 times your risk. For bearish setups with red channel, red ribbon confirmed, wait for price to rally to the upper band or midline. Then enter short on bearish rejection candles, long upper wicks with weak closes. Set your stop above the upper band and target the lower band or 2R. Before I show you the next strategy, remember this: learning indicators is one thing, but applying them within a structured process is what really matters. That's exactly why we've created a place where you can review these strategies, see live examples, and study them in real market conditions. Just click the first link in the description whenever you're ready to explore further. Now, different markets require different regression settings for best performance. For forex pairs, set look-back period to 120 for major pairs like EURUSD and GBPUSD. Forex trends are consistent but move slower, so the longer look back captures the mathematical structure better. Keep channel width at default as forex volatility is relatively stable. For crypto, drop look back period to 80 for faster adaptation. Crypto trends form and break quickly, so you need the regression curve to respond faster. Increase channel width slightly to account for crypto's violent swings, as you don't want to get stopped out on normal volatility. For stocks, use a look back period at 150 for swing trading on daily charts. Stocks trend steadily over longer periods, so the extended look back gives you a cleaner mathematical fit. For day trading stocks, drop it to 90 on 5-minute charts. For gold, set look back period to 100, but watch the dashboard slope value carefully. Gold has explosive moves with sudden reversals, so pay extra attention when the slope value exceeds plus or minus 2.0. That's extreme momentum that often precedes exhaustion. Thanks for watching, and I'll see you in the next one.